Hey everyone, Dan again, back from stocktrades.ca. We've got another video for you this week. We didn't produce one last week because of the holidays, and I hope everybody here had a great holiday, had some time with their families. Now you're ready to get back at her. It was kind of the same with us. We didn't produce a video last week just because too much was going on, but we're back at it this week, and we're going to speak about 5 stocks here in Canada that pay monthly dividends. We view these as some of the best monthly dividend payers in Canada. So with that being said, let's get started. Now, one thing I want to go over before we get into this list of monthly dividend payers here in Canada is there is a slight advantage to purchasing monthly dividend stocks in terms of returns. You're going to see a higher return, although it is very small, and I can't stress the fact that you should be looking at these companies for the quality of their dividend, the safety of their dividend, and the overall quality of the company before you just look to see, oh hey, they pay a monthly dividend, I want to own them just so you can get cash every month. That's not really something you want to do, and that's going to get you into trouble if you're just looking at monthly payers because you want to make an extra, 0.25% a year, 1/8% a year. That's how minuscule it is if they pay monthly dividends. So with that being said, let's take a look at our first major monthly payer here in Canada. First monthly payer we're going to talk about is Inter Pipeline. They trade under the ticker IPL on the TSX. They're a midstream pipeline company, and out of all the pipeline companies, they have one of the best yields you can get, especially considering their growth streak, which we'll talk about later. But as of right now, you're getting a yield of 7.59%, which is 2% greater than the industry average of 5.5%. When you think of other pipeline companies, TC Energy, Enbridge, they all pay a dividend in the range of 4.5% to 6%. So Inter Pipeline is definitely above that. Their Heartland project, and what the Heartland project is, essentially, it's a project the company plans to develop and finish in late 2021, and it's going to convert propane to a particular kind of plastic. The Heartland project overall is going to increase EBITDA, which is earnings before interest, taxes, depreciation, and amortization, by 420 to 450 million. Quick overview on EBITDA before we move on. Some people prefer to call it EBITDA. It doesn't really matter, the letters, the pronunciation. It's a judge of financial performance by a company and is often used in place of net income or simple earnings. It's often been referred to as a more precise measure of performance due to the fact it takes into account money coming in before accounting and financial deductions. The company has the second longest streak among monthly Canadian dividend aristocrat payers at 11 years. The 5-year dividend growth rate for Inter Pipeline is around 5%. So you're only getting mid-single digit growth with this company, but with a yield of 7.59% to start out, it's not really something you should be too worried about. Their most recent increase, they essentially raised their dividend just to keep the streak alive. They only raised it by 1%. Some dividend highlights, like we said, the yield is 7.59%, and the company pays out about 86% of operating cash flows towards their dividend. This is a little high, but considering they've raised dividends for 11 years, it's not something we're too concerned about right now. And analyst estimates, they have a 1-year target price of $23.95 on the stock, which signals around 6% upside as of today. Out of the 14 analysts, 7 rate the company a buy and 7 to hold. 6% upside along with a 7.5% dividend yield. There's a chance to make outsized gains with Inter Pipeline during this point. So the next company we're going to talk about is an airline company, Exchange Income Corporation. They provide small chartered planes around Canada, emergency medevac services in Manitoba, Ontario, Nunavut, and they also provide aftermarket parts for airline companies. So the company has seen some very strong growth over the last 5 years. 19% annual share price appreciation. Essentially, over the last 5 years, the stock has doubled, along with providing an excellent dividend yield, which we'll get into later. They have double-digit earnings and revenue growth estimates over the next few years. And considering this company yields over 5% and only trades at 13 times forward earnings, Right now, we see this as a very strong growth opportunity. So, valuation. The company, like I said earlier, is trading very cheap. 13 times forward earnings with an industry average of over 20. They have a PEG, a price to earnings to growth ratio of below 1. And if you didn't watch our last video, the price to earnings to growth ratio essentially takes the company's price to earnings and compares it to its growth moving forward. You want to see a number under 1. So along with these excellent growth prospects, the company also has an excellent dividend. They have the second highest yielding stock in the industry, and they are the only airline to achieve Canadian Dividend Aristocrat status. So companies like WestJet, Air Canada, they haven't even achieved this. Exchange Income Corp is the only one to do so. Some dividend highlights. The company yields just over 5% and has a payout ratio of around 94%. Which is some cause for concern, but considering the company has raised dividends for 9 years, it's not something we're too concerned about, especially considering that as of right now, the company's dividend makes up only 30% of operating cash flows. They have a growth streak of 9 years, and their 5-year dividend growth rate is about 5%. So you're not going to get much growth out of the dividend, but considering the company's overall growth and the value they're trading at right now, I would say a 5% yield and 19% annual share price appreciation is something that investors really aren't going to be that disappointed with, and a 5% dividend growth rate is just kind of a cherry on top. They have a 1-year price target of $48.64, which implies about 9% upside at the time of this video. Out of 11 analysts, 7 rate the company a buy, 2 a strong buy, and 2 a hold. I tend to agree with them. I'd be looking at Exchange Income Corp right now if you're looking at a stock that you want in terms of growth, or if you're just looking at a dividend payer. And the fact that it pays a monthly dividend is just kind of an additional bonus. So let's take a look at our next stock, which is Parkland Fuels, trading under the ticker PKI on the TSX. Parkland Fuels is a Canadian marketer, distributor, and refiner of fuel and petrochemical products here in Canada and the USA. And they have grown a lot by acquisition over the last 10 years or so. A few acquisitions, notable acquisitions of late. In 2017, they purchased Chevron's refinery in Burnaby. In 2014, they purchased Pioneer gas stations for nearly $400 million. And they bought Ultramar in late 2013. The company has achieved exceptional growth over the last 10 years. I mean, we looked at Exchange Income Corp, our last stock. They achieved gains of around 19% over the last 5 years. Parkland has done this consistently over the last 10 years. So essentially, over the last 10 years, this stock's price has doubled twice. Now, considering the company pays a dividend, this is quite exceptional. I mean, to achieve that kind of growth all while paying a mid 2% yield with a 60% payout ratio. I mean, it's very hard to find the money to buy these companies or fund this growth when you're paying out that much. So that's really a positive for the company. The main reason is because they're a market leader. They're one of America's fastest growing independent fuel retailers, and I would expect this to continue in the future. Some highlights, like we spoke about, they have a yield around 2.5%, payout ratio of 60%, and they are a Canadian Dividend Aristocrat with a growth streak of 7 years. So, analyst estimates for the company, they have a 1-year price target of $52.75, which implies about 7.7% upside. Out of 7 analysts, 6 rate the company a buy or a strong buy. One of them rates it a hold. Parkland Fuels has been a great stock. They've been a great stock for quite a while now. I own the company. I've owned the company for quite some time. If you're looking for a monthly dividend stock, along with some potential for outsized growth, they're definitely a stock you want to look at. All right, let's move on to our next stock, which is Saawariya, trading under the ticker SIS on the TSX. So what does Saawariya do? Saawariya essentially makes mobility projects for aging or disabled people in Canada, United States, and internationally. And why is this important? The population is aging. In 2014, there was around 15% of people that were 65 years or older here in Canada. They expect by 2030 that number to hit 23%. So people will need these mobility products they'll need easier vehicle access, stuff like that. So Saawariya has been a consistent grower over the last half decade, 13% in annual earnings growth over the last 5 years. And they also have big expectations for the future. Analysts actually expect them to increase this rate. In fact, they actually expect them to nearly double it, 20 to 25% average annual earnings growth over the next 5 years. Another thing we really like about Saawariya is their strong dividend growth. The company has the highest dividend growth rate among all monthly paying dividend aristocrats. Their 5-year average is 27%. So that essentially means that this dividend is doubling every 4 years. So some dividend highlights for Saawariya. They currently pay a yield of 3.25% and they have a payout ratio of 90.6%. And one thing we can look at with Saawariya is they are paying out 130% of their free cash flows towards the dividend. And this is cause for concern with most companies, but with Saawariya, I think the one thing we'll need to see first before we lose confidence is their growth rate shrinking. If they keep increasing dividends at this rate, we're not too concerned right now. But if their dividend growth rate starts to shrink from that 27% point, that's a sign that the company may be paying out a little too much. So analyst estimates for Saawariya, they have a 1-year price target of $17.32. This implies 24.4% upside, and all 6 analysts rate the company a buy. Just wanted to take a break from looking at these stocks and ask you, if you liked the video, head down below, subscribe to the channel, like the video, hit the notification bell. That way you're not going to miss our next video, which is coming up really soon, and we're going to be going over some more great Canadian stocks. Let's get back to our last stock, Pembina Pipe. So the next stock on our list is Pembina Pipe, trading under the ticker PPL on the TSX. Pembina Pipe is another midstream company just like Inter Pipeline, but in terms of growth, they've been the top performing pipeline over the past decade with average annual returns of pretty close to 14%. So not only will you get a yield of over 5% buying the company today, you're also going to get strong growth. They've put up that strong growth for over a decade now. Long-term expectations. At 8.5%, it has the highest expected 5-year average annual growth rate. That means out of all the pipeline companies, Enbridge, Inter Pipeline, TC Energy, analysts figure that Pembina has the greatest chance to outperform all of them. So one thing you need to have a stable dividend is stable cash flows, and Pembina offers just that. 86% of cash flows are underpinned by fee-for-service contracts, and 65% are take-or-pay. What a take-or-pay contract is essentially if the company who has agreed to move product with Pembina, if they don't use the service or use the maximum volume allowed, they still get charged. So this is a very reliable form of cash flows. Another strong aspect of Pembina Pipe is its dividend growth. The company has dividend growth in the high single digits, and this is primarily due to the fact that the company has been able to make acquisitions that help their top and bottom lines and thus increase their dividend. We can look to their most recent acquisition in late 2019 to purchase Kinder Morgan Canada for around 4.5, I think it was 4.3 to 4.5 billion dollars. The company purchased Provident Energy for 3.1 billion back in 2012. That was an all-stock deal, I believe, and they purchased Verizon Energy for 9.7 billion in 2017. Now that was a key acquisition because Verizon was essentially a natural gas company while Pembina mostly looked to move oil and other liquids. So this really helped them diversify their product base. Dividend highlights. The dividend yields around 5%. The payout ratio is about 78% of distributable cash flows, and they have a growth streak of around 8 years. Analyst estimates, they have a 1-year price target of $55.28, implying around 15.7% upside from today's price. Out of 18 analysts, 15 rate the company a buy and 2 a hold. Well, that's it for our list of 5 monthly dividend stocks here in Canada. We hope you like the list. We tried to change it up, provide some growth in Saawariya and maybe some high yield in Pembina and Exchange Income Corp. It's important to note that we haven't included REITs in this video. This is only stocks. If you're looking for REITs, we have a video coming out soon. It's going to go over 5 of the best in the country. And so you get it when it comes out. Head down below, subscribe to the channel, like the video, and we'll see you next time.